Welcome back to the What's More podcast. I'm your host, Quinton Harris. You're dialed in for episode 232. Kind of an exciting week over here on this front. You know, we had Fed meeting. We got a recap of what was going on and said there. More importantly, what does it mean to you as a homeowner, a potential homeowner, and for those of us that live here in Jacksonville, Florida? All that and more in this episode at What's Your One More. All right, so here it is, Friday afternoon. You know, we're pushing 4 o'clock. I like to do these podcasts at the end of the week, especially all this data that's dropping out there, and just think about how to apply. You know, a couple weeks ago, I was in Austin, and I was like, man, I want to take a look at this residential market, see what's going down over here. Interviewed quite a few people while I was out there, talking to people. Interviews kind of a loose term, but just kind of chatting it up with people as we went to different locations. We were there for a business trip. And man, you know, Austin's one of those markets that you think is hit so hard because on paper they talk about like the depreciation or whatever's happened over the last year. But the reality is, man, don't tell people in Austin that there's a lot of deals to be had and a lot of really happy real estate owners that are there. I didn't see half the stuff with them that I read online, and that just kind of creates a perspective that I think, you know, I like to value, because I talk about it all the time, like the stuff you see and the stuff you read and these doom porn things that are online that I talk about, the people that are always pumping this crash is going to happen. Some of them changed their tune already, by the way, and you know who they are. Some of them have backed up and punted and decided they're not going to preach a crash anymore. That real estate is actually going to make money now. And I think there's reasons for that. But where I'm going with this is that I think also is a great example that, hey, listen, don't believe everything you read. Like, get down in the weeds and go check it out for yourself. And I thought that was really cool there. And it seemed to be a really very positive real estate market there. So it was definitely cool, and going to be going to Tennessee the next couple of weeks. Check that out as well. I think there's some things to be had there to kind of talk about. So this week was a big week. We had Jerome Powell at the podium. We had the Federal Reserve, and then we had inflation. The Fed's favorite form of inflation came out Friday after they talked. So, like, what does that mean? Like, why do we even care about that stuff? And I think it's interesting because now we actually have like a live stream from the Federal Reserve where you can actually watch them at the podium, which couldn't be more boring that you could possibly imagine. But it felt a needed live stream. It's because the markets move and hang on every word the Federal Reserve says right now. Not just the mortgage market, but the bond market, stock market. In this particular podium setting, you know, we used to do a segment called the Jerome Powell Show because it really used to be about Jerome Powell. But if you recall back into my 2025 forecast, one of the things I talked about was when this new administration comes in, how does the Federal Reserve act and how do they embrace some of the things that Donald Trump has specifically said he wanted to see? And so what we saw was the first podium, if you may, from Jerome Powell under the new administration. And my, oh my, was that a different take than what we've seen over the last 4 years. Yes, it was still Jerome Powell. Yes, it was still a very dry sense of humor, if you may, and a very direct to the point about certain things and beat around the bush on others. But some of the answers, though, were much different than what we previously were getting. Right out the gate, you anticipated him to get peppered with questions about Trump and this administration. He cut off, said, I'm not going to answer any of those questions involving that. And so what he did say was the following, though. There was some commentary that came out from the Federal Reserve, and they had talked about inflation. And as we know, they have two mandates: get inflation to 2%, and then they wanted to see the unemployment market at maximum unemployment, or maximum employment, excuse me. So one of the things they said was they removed a statement out of the previous statement, and where it said inflation, essentially it said inflation just remains somewhat elevated. But previously they had said inflation has made progress towards the committee's 2%, but remains somewhat elevated. By taking out that one little section, has made progress toward the committee's 2%, it freaked the markets out to the same point that you started to see like this negative reaction, because what happened was investors and people on Wall Street were like, oh my God, they're going to raise rates now. That remains elevated. They're scared. They're concerned. And so, thank goodness, one of the reporters in the room asked the question, like, hey, why did you remove that? And Powell just said, yeah, we just thought the sentence was too long and we just wanted to shorten it. By no means do we think it's, you know, it's could rear its ugly head. And I thought that was pretty wise of him to calm the markets down. We started seeing an immediate reversal trends in the market as soon as he did that. But where the real juice in the actual interview, and what I want to talk about on the show today that really kind of set the tone. Now, remember, I've called for 4 rate cuts, maybe 6. And I said the Federal Reserve was giving us a head fake when they said they're only going to do 2 based on that dot plot map. Here's where I think we start to see the 4 unfold. He was asked specifically about the mandates and the executive orders from the new administration and Donald Trump. Well, his reply was the actual foreshadowing of what you're going to see. His reply is what sets the stage for why I think the rate cuts are 4 to possibly 6. He said the Federal Reserve will comply with the executive orders that have been mandated. So he was saying our job is to comply with the executive orders. That's exactly how he answered the question. Well, we know Trump signed the executive order for more affordability in housing, and he wants to do that by lowering rates and making homes more affordable by lowering some of the prices for new construction. We know that those are things that he's trying to accomplish. And Jerome Powell just told you what they're going to do. They're going to comply with that. And I think that's just the start. And if you're a future homeowner, this should be encouraging. If you've been on the sidelines waiting for these rates, you're already starting to see it. I'm going to pull up a graph here. And if you're not on our YouTube channel, go check us out at What's Your One More with the number 1. That's at What's Your One More. Subscribe. You'll get a look at these graphs as we put them on there. And I'm going to pull it up here on my laptop while I'm talking so my producer can put it in the show here as we go through this. But one of the things that we look at on here is we talk about the spreads getting better. We talk about the difference between the 30-year fixed rate mortgage and the 10-year treasury. My computer's not cooperating here, but we'll figure this out. So anyhow, what we're seeing is that there's always, as we talk about making the mortgage, there's the spread, and we talked about that significantly. That's the investor's risk and tolerance in a mortgage, and then the actual 10-year treasury. Put those together, and that's your interest rate. Well, if you take the 10-year treasury right now at 4.52, and you say, when was the last time that closed at 4.52? Well, that was back in May of 2024. The interest rate at that time was 7.22. Today, that exact same treasury is 6.95. So you're seeing a 30 basis point differential. That's that spread evaporating. That's the risk from the investor starting to become less and less riskier in the threat of a refinance or a prepayment or paying it off. So you're starting to see investor confidence grow in there, and it's getting better. And one of the things I harped on over and over again during many of podcasts, but especially the 2025 forecast, is it doesn't take the Federal Reserve lowering the Fed funds rate for mortgage rates to come down, because there was so much spread that needed to go away, and we're starting to see that happen. I think over the course of the next weeks to come, now remember, the next Fed meeting, if you look it up, that's not till March, so we got plenty of time. The next Fed meeting is actually in, it's March 19th, so we've got roughly 6 weeks before we get to that. What happens over the next 6 weeks? Do we see some windfall here? Do we see more favorable economic data come out? Well, we got one on Friday. I think that's a win, and it was the PCE. That's the Fed's favorite form of inflation. And you heard Powell talk about that at the podium, but the reason I think that's a win is because the Federal Reserve says, we think inflation needs to be at 2%, and they harped on it and they talked about it. But one of the trends that we saw on there was one of the reporters said, hey, Powell, if you don't get to 2%, are you gonna wait to lower rates until you get to 2%? He said, absolutely not. Like, we don't need it to get to 2% for us to reduce rates or to lower the Fed funds rate. I thought that was interesting. Again, another sign of this is what we think is going to happen, and more rate cuts to come, not just one or two. If some of the stuff we're talking about on the podcast interests you, and you're like, hey, Q, I want to be a homeowner. I want to buy an investment property. I want strategies on how I can take advantage of the market. I have a solution for you. And that solution is Loan People, to where it's all about the people getting the loan and the people doing the loan. You guys know me by now. I've been doing this podcast for years, but I've been in the mortgage business for 23. And it's very rare you can find a company that has a mantra for loan officers, by loan officers. And what does that mean? That means you have a company that's designed to help provide the best atmosphere for loan officers possibly imagined. And not only that, the most efficient operations for those loan officers to be successful, which provides a better customer service. And that's what you get at Loan People. So much so that they put that in the company name. And at the heart of this is the people. It's in-house processing, it's underwriting, it's closing and funding. And why choose them? They got great rates. They close on time, and they have award-winning service. So check them out at loanpeoplejacks.com. That's loanpeoplejacks.com. So we'll pull up a couple of things in here because they are saying, listen, we want a core 2%. Now, with core, obviously, you're taking out food and energy. Right now, the core is at 2.8. However, we also know that the shelter is a lagging component, meaning that today's shelter cost is not being included in the PCE reading currently. It's a lagging because it's a 12-month lag. So if you were just to use today's shelter cost reading, that would actually be closer to 2.2. And I think the Federal Reserve is smart enough to figure that out. They know that, and they are very close to the 2. I think that you're going to see more signs between now and the 6 weeks of this lowering of the Fed funds rate. And as the investors start to feel that, as they start to seek that or sense that, they're going to react to that. And I think that's why you're going to see the bond market come down. And I think that's why you're going to see the spread start to evaporate. And where I'm going with this is we're already in the 6s, the upper 6s, right? And the Federal Reserve didn't do anything. What happens when they do something by lowering the rate and we start to see these spreads evaporate? And next thing you know, as I said, by the end of March, I think we're below 6.5. And as we go into that second quarter, I think that's when we finally reach and get to that 5.875. And we're right on track for that to happen. And that's really important because if you're a homeowner, maybe you're timing yourself around that. If you're a real estate agent and you have clients that are like, oh man, I don't want to buy now, but I'm definitely comfortable at 6.5 or below. go ahead and get ready. Like, go ahead and queue it up, because I think you'll be there by the end of March at the 6.5. And then as we get into Q2, you're going to start seeing that 5.875 / 6% range in there. And if you're putting discount points like almost everybody is on loans right now, that's very reasonable and attainable. Something else to think about on here was that Powell was asked about the stock market. Is it inflated? Is it an asset bubble? I thought this was interesting. He didn't say it was an asset bubble, but he definitely said that he believed that it was inflated. I thought that was interesting to come from him. And then the crypto question came, which was really interesting because he was asked about crypto. And the reason I bring that up is because it's an asset that's hard to ignore right now. It's getting incredible results, and it's at all-time highs, and it keeps hitting them and then coming down and hitting new ones. So it's a very interesting dynamic. Plus, a lot of banks are involved in it now, and they're using it in their in their ETFs. So he was asked about it, and he said, well, I understand now why banks are having it in their portfolios, and consumers are having the option now to invest in it in multiple different ways. And he really didn't answer the question. And so the guy came back and said, do you think it's a risky asset? And he said, well, I think Congress at one point was looking at regulating the actual Bitcoin environment in the United States. And I think that's something they should probably heavily consider and look at doing further and continuing down that pipeline, and probably do so that no consumer is harmed when they go to buy one of those. I thought that was interesting because for a minute there, the crypto crowd was roaring, and it was like within 2 seconds, he was like, yeah, but I think it should be regulated. And depending what side of the coin you're on there, no pun intended, that the regulations widely accepted from some on that side of the table in the form of why they think that'd be a good thing to further justify that asset space. And it would probably increase prices for some and desirability for others. I thought that was super interesting. So why is all of this interesting, more importantly, important in what we talk about? Well, the Fed can move the market very easily. And the news does a really poor job of explaining what they're doing and how they're going about it. But as a homeowner, here's what I would look at. I'm looking at labor over inflation. We continue to talk about that. And when the labor market doesn't feel right and doesn't look right, that's when you see signs of softening in the economy. We're going to be getting job reports over the course of the next couple of weeks as job weeks come in. We're going to start seeing some signs of what I consider to be a weakening job market. I think ADP, the private equity sector, came out and already showed some, not misreadings, but some backing up of the previous reports they had. And some of those are indicating that even in the private sector, they overreported how many jobs they had. And where I'm going with this is I don't think we have as strong of a job market as the Federal Reserve is indicating. I don't think the 4.1 that Powell basically touted at that podium is a 4.1. I think it's more like 4.5. And I think we're going to find that come about pretty quickly here. And as that job market softens, they're going to react. That's the reason for another cut on here. Plus the other things I just described, the rate cut from the Federal Reserve is going to compound some of this evaporation that we're talking about in the 10-year Treasury, as well as on the spread for the 30-year fixed rate. It's going to be a win. It's going to be an exciting season for us. And as the forecast said, the second quarter is where it's going to be at for us, and that's going to time out with seasonality in the market. Hey, it's just January. We're at the 31st. We haven't turned into February yet, and things are already trending the right way, and I'm very pumped about that. So, guys, if you like what you're hearing, please leave us some comments. Check us out on YouTube at What's Your One More. I love all the feedback you guys are putting on there. All of our graphs, all of our charts are on there. Check out that forecast we did. If you didn't listen to that, then check out this episode as well. Refer us to a family and friend. Check us out on Apple and Spotify, as well as any other platform you listen to your podcast on. Till the next episode, we'll see you at What's Your One More.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into it, yeah.